Hello, everyone. Welcome to episode 8 of our 321 Q&A session. And in this episode, we have a very special guest, Stefan Rivere from Sun Tzu Lab, who will talk to us about the importance of best execution regulations and transparency in the liquidity for the institutions to mass adopt crypto. Then we will move on to two important Twitter threads that our users need to be aware of. And the first one is related to how a Twitter user helped prevent a $200 billion BitBTC exploit. And then the other thread is related to JP Morgan executing its first on-chain DeFi trade. And then finally, we'll move on to analyzing a DeFi hack, which is related to the Derebit exchange hot wallet hack.
Okay.
So thanks for joining us, Stefan. First, could you give us an explanation of what Sun Tzu does and how your service is catering to different clients, maybe focusing on the type of clients that you have specifically?
Absolutely. Hello, Jerome. Hello, Pratik. Thank you very much for having me here. So what is Sun Tzu about? Sun Tzu was born 2 years ago as at the right initiative to answer a number of questions about liquidity. Okay, so basically when we looked at the market for crypto assets with the eye of an institutional trader, we were wondering, are those things liquid? And in general, on a more general dimension, how are those markets organized? How are they structured? And with the intent of determining whether investors would find their way to the right liquidity and the right price. Okay, and back then in 2018, we couldn't find any adequate answer. Now there are people providing services and so on, but we couldn't find the institutional grade answer to the question of how do those assets trade and where do I find liquidity if I'm an investor, if I'm an active or institutional investor. And so we decided to start Sun Tzu to answer that question. Okay, so that's that's the origin. Now, how do we do that? What do we provide in practice, and who do we provide it to? Well, basically, we deal with data. Transparency is a matter of data. The data you get from transactions, past transactions, the data you get from order books, venues, whether centralized or decentralized. You collect the data and you look at it and try to extract information from that data. So we have a data business, except we go beyond the data and we provide solutions in the form of recommendation, answers, and data feed, augmented data feed. So practically, we provide data with a lot of added value so that investors or clients can find answers to their questions and problems. And now the third aspect of the question is, who do we provide it to? Well, everyone, really. We don't do any transaction. We are not providing execution services. We're not providing investment advice. We are very agnostic to anything that has to do with token recommendation or ecosystem recommendation or blockchain recommendation. We consider it's not our job to decide what investors should gain exposure to or when they should get exposure to. So that said, it enables us to speak to a lot of people because we can essentially engage in a conversation with everybody in the ecosystem, whether it's a venue, centralized or decentralized, whether it's a blockchain system, and we have a client that is a very significant blockchain ecosystem, whether you are an investor, high net worth, institutional, or quantitative hedge fund, on crypto, or you are a larger hedge fund trying to diversify into crypto, we can talk to everybody and anybody. If you're in the crypto space, chances are you're transacting, you're trading, so you need us to better transact. And I'll come back in a second on another question as to why it matters, transparency matters in general, but we help you with transaction costs. So we help you save money. So that's if you're in the industry. If you're not in the industry, chances are you really don't know where to get started. If you're a regulated entity, then liquidity is not an option for you because regulator in traditional markets, regulator has some very demanding corpus, which is called best execution for liquidity analysis, pre-trade and post-trade. So if you're regulated and you fall under best execution guidelines, then you expect to find the same thing in crypto. And so far, nobody's providing that, except for us, of course. And so you would come to us very naturally saying, okay, I'm used to best exec in the world of traditional finance. I need best exec in crypto. Where do I find it? And that's where we come into play. So because we are very neutral in terms of transaction, we are free of conflict of interest. So we can associate, we can engage with anybody. And because we know what happened in the traditional space of best execution with traditional finance, we have very strong expectations about what will happen in crypto. So for those who are in it, or those who are about to enter, best exec is just around the corner. It's in fact mentioned explicitly in MiCA, and we think it's going to be it's going to hit the radar of a number of participants very, very soon.
Interesting. So you guys work with institutions, exchanges, high net worth individuals. What is stopping these institutions from mass adoption? Is it the lack of clarity and transparency on the liquidity? What exactly is stopping this mass adoption?
Okay, it's a very wide question. There are a number of things that are preventing institutions to enter the space. But first of all, we should start by making a distinction between what is a traditional institution and what is a crypto institution. I mean, if you're a small hedge fund and you have 5, 10, 15 million AUM, asset under management in crypto, you are an institutional investor, yet you are a small one. I mean, in the world of traditional finance, we're talking about institutional investors. People have CalPERS in mind. They have the likes of retirement pension funds and so on. This is very, very big money. Those guys are still not invested in crypto, and the reason is they can't for regulatory purposes. Okay, and by regulatory reasons, I mean there are a number of chapters, but custody is one of them, KYC AML is another one, and transparency is also another one. I will come back to that in a second. So massive adoption from smaller funds is really on its way. And there are some collective investment schemes in place. People have started funds already dealing with crypto and crypto only. So this is happening. And by the way, with the information we have, points to the fact that it's those types of institutions dominate the volume in trading. Okay. So they're already there. Doesn't mean that they have all the tools they need, but they're already trading and they're doing whatever they can to get the best liquidity. Now, as far as the big investors are concerned, when the answer to the question, why don't they come? As I said, there's very strong regulatory aspect, KYC, AML, custody, and so on. But beyond that, liquidity is a big deal. Now, we've looked at a number of surveys that have been released recently over the past 6 months, and there's one from State Street, and there are others, but one from State Street that the digital asset team from State Street went to its traditional institutional clients and asked the question, what is the major obstacle for you to join in? That's a digital asset market. And transparency was number 2. The first one was cybersecurity, which you can understand with all the news that you have almost daily about hacks and fraud and so on. Okay, so that's a fair share of worry for the traditional institution. But the second thing comes transparency. Now, transparency means different things to different people, but in general, it means how am I going to get the right information to trade without paying too much in execution costs. Now, and that brings me to what I was saying before, which is why is Sun Tzu important? Why is our mission important? Because transparency is a question of execution cost. In an opaque market, you are going to pay more for the Bitcoins you buy, and you are going to get less for the Bitcoin you sell, because intermediaries and a lot of participants will take a lot of money from your transactions and won't even say it. They won't even disclose that they are collecting a lot of fees, whether those fees are in the form of commission or hidden costs, such as impact. Those fees exist, and this is money that is going out of your pocket. Okay, so transparency is directly linked to the efficiency of the market, which means you're paying more and you're paying too much for the services you get. So why is our mission important and why we take it very seriously is because transparency in the end translates into lower transaction cost and more efficient market. And by the way, that is the mission of the regulator. Regulators consider that part of the mandate is to bring efficiency and transparency to markets because in the end, investors benefit in the form of lower transaction fee and more money invested and more money saved. So once the market, the custody problem is being addressed, the KYC AML problem is being addressed. I mean, the regulators are on top of it. Everybody knows that it's an issue. Everybody is providing solutions. They are more or less adequate depending on the jurisdiction, depending on the regulatory pressure, and some regulators differ and so on. But you know, custody is being addressed, and the KYC AML is being addressed, and rightly so. We believe the next one is transparency. And so if you take an institutional investor, a traditional institutional investor, and those guys have, as I said, big pockets, those guys will immediately want billions of exposure. If you take all the small guys' savings for their retirement and they want a 5% allocation to crypto, which is not much, by the way, 5%, then this is going to translate to billions and billions of investment money. For that money to find its way, it needs to find its way to transparent market, so that institutional investors know their way around, don't know that they're not paying too much, and then the regulator knows that the small guy is not being unduly taxed or unduly charged for the services he's getting as part of his retirement pension fund. Okay, and so that layer of transparency we believe is coming. It's a good thing, by the way, for investors. It's also a good thing for the industry, because what Best Exec did in traditional finance, it organized competition. Okay, so with the Best Exec framework in place, suddenly, as an investor, I'm able to compare my different providers and see when and how I can get the best price. By the way, if I'm an execution provider, or if I'm a venue, or if I'm anybody providing liquidity, there is a Best Exec framework in place. I can also compare myself to the next guy. Okay, so it helps me compete. Okay, so I can objectively go to a prospect investor and tell them, look, this is what I do. This is what liquidity you will find. This is a transparency that I offer on my order book or on my DeFi platform. So this is all the data you can access, and come to me, because you will find the liquidity you need, and we know that you get the best price and the smallest commission, or the smallest hidden prices, such as impact and slippage. And if I can do that, comparing myself to the next venue, then it's for my benefit if I'm better. You know, the better is going to reach the most, the best marketplace, the best venue, the one that has the most liquidity will attract the most customers and most trading clients, and that's the way it should be. Okay, so opacity is an impediment to trust, obviously, among end clients, but also in the industry. And so if you bring transparency, suddenly you organize a much better competition mentality, and you enable participants to benchmark themselves, investors to benchmark their service providers, and that's how the industry is going to grow. It's not going to grow very much under the belief that, you know, I should keep my practice opaque, I should keep my prices opaque, I'm going to give this price to the guy on my left because I like him, and I'm going to charge that much to the guy on my right because I don't know him and he's not trading enough for me. Those practices, which are still in play in some places, should disappear if the market is to grow and mature significantly and attract more and more small guys, because that's what we're talking about. We're talking about the money that small people, small investors would want to invest, and that they will not invest directly, but that they will invest in fund managers, himself aggregating a lot of that money. And as I said, probably ready to invest billions and billions when the proper setup is in place.
Interesting. So definitely net benefit for everyone in the space, whether for the big guys or whether for the small trading people. We do cover some of those requirements in institutional report that we co-author with Sanzu that people can read in our website at coinchange.io. I wanted to go back onto the liquidity and specifically about the big money of the pension fund that you mentioned. So would you say that best execution could be a way that those could enter together? Those institutions could enter the space via the best execution provider together with your analysis. An example that I'm thinking would be those pension funds might be allocating, let's say 1%, but 1% of their AUM might be worth billions, which might be moving a lot the market because we might have a lack of liquidity. So does best execution would be kind of a solution for those in order for them to enter with staged entry or something of the sort?
Absolutely. I mean, put yourself in their shoes. Okay, you're in a pension fund. You have hundreds of billions under management. You're invested in equities, international equities, bonds, and so on. And you have a lot of asset classes, private equity, venture capital, and so on. And suddenly you realize that you need a pocket for crypto. You need a 3, 4, 5% allocation to crypto because your clients expect it and because it's wise diversification. Okay. What do? Then you turn to the crypto market and you turn to a prime broker that you know, or a broker that you know, or research companies that you know, and you ask the question, how should I go about it? Okay, I find myself with, I don't know, 1, 2, 3, 4, 5 billion to invest over a short period of time because you want to enter the market as quickly as you can. How should I go about it? And then turn to market and you realize that there are 10, 20 DeFi protocols in place, that you have 50, 60, 70 centralized venues, that you have liquidity providers that can do OTC trading or that can do on-exchange trading and trade with one another and so on. How do you trade? I mean, it's a very, very simple question. I have 1 billion. Should I go with one intermediary? Okay, because that's a lot of money to give to one single broker. Should I go to 2? Which one should I use? Okay, and the guy comes to me and says, look, I'm going to do commission-free trading, but here is a price. Okay, so if it's commission-free, then maybe the price incorporates some sort of margin. How much margin? Okay, so broker A is giving me a price with no commission and margin. Broker B says, okay, I'm not going to give you a price with margin, but I'm going to charge you commission. Okay, so I get 5%, 5 basis point commission and a different price. How do I make sense of it? How do I know that in case A or B, I got the best price? How do I know that those guys did a fair job at getting liquidity? Okay, and they gave me my billion execution over a period of 5 hours. How do I know that if I had chosen a different mix of brokers, I wouldn't have been able to have it in 3 hours? Okay, how do I know that I should trade on 5, 10, or 15 exchanges as opposed to 20, which means all sorts of questions. Okay, now, why do I need to answer those questions? Because the regulator, I'm a pension fund, so I'm already under heavy regulation, and the regulator asks me to justify every single order that I place to an intermediary. So I go to a broker. When I buy a $500 million chunk of General Motors, I have to justify every single dollar of it. And the broker gives me a best execution report saying that, your 500 million were executed with such and such and such strategy, and the price is this. And by the way, we can demonstrate with data that we couldn't do better. So that's the way I'm being treated in the traditional space. How am I going to be able to trade in the crypto space if I don't get the same treatment? If I don't get the same information, if I cannot justify to my regulator and to my clients, because in the US, but it's also true elsewhere, you have the notion of fiduciary duty. Fiduciary duty means you have to properly manage the client that you're being entrusted with and the money from that client. How am I going to document the fact that I did a good job at allocating the money and paying commissions? Okay, this is a very, very old problem. It's been addressed by regulators worldwide in different ways. Best exec is one of them, but it's a very practical problem. And so when the answer to your question is, you're asking me, how is that a necessary step? What am I saying? If you don't have anything like a best exec, how would you go about it? You simply can't. You simply cannot justify. So of course, you're going to give a chunk of your trading to one firm and another chunk to another firm. You're going to get prices and you hope for the best. While hoping for the best is usually not a fantastic sustainable strategy if you really want to compete. And competition in the crypto space is going to be like in traditional space for execution. It's going to be very, very fierce, very, very soon. If it's already the case, by the way. So to compete, you need a little bit more than hoping for the best. So the answer is it's absolutely necessary, and it's absolutely necessary now, because if you don't have it, you're absolutely blind. Well, and so that's what we believe. And we believe that the industry should consider adopting it faster than the regulator will impose it. Because if you do it yourself, chances are you might gain some negotiating power vis-a-vis your regulator, and you might gain some benefits in policing yourself before a regulator comes in with heavy-handed regulation. And we've seen that in other chapters, but heavy-handed regulation is certainly on the horizon if the industry doesn't stand up to the task, in fact, and and as well as other subjects. But here we're talking mostly about basic. So yes, it's a very practical and very common question that that needs to be answered according to certain standards.
So, Stefan, I have a follow-up question on that. So there's best execution requirements in traditional finance and versus best execution requirements in crypto. On one hand, I feel like crypto is on public blockchain, so the data is more available. So it might make it easier to have the liquidity metrics for the institutions to give them the best execution price. But on the other hand, because there's a lot of anonymity and lack of regulation, a lot of the volumes on these venues are inflated artificially by wash trading or some kind of high frequency trading and not knowing who the participants are. So is it easier or harder compared to traditional finance to offer best execution services in crypto?
Okay, today it's definitely harder. Okay, because of what you said, because the data that is being produced by the system, whether it's centralized venues or whether it's decentralized venues, the data is inflated, manipulated, and or outright false in some cases. Okay, so because of those circumstances, the job is just much more difficult. You will never get Eurex to publish inflated volumes, or ICE or the New York Stock Exchange or anybody publish inflated prices. And as far as I know, they never did it, but then they were very early, they were taken by very strict regulation, so they were never in a position to do it anyway. In crypto, everybody is in a position to do it. Okay, now on centralized exchanges, it's even easier because really you have no way of knowing what the matching engine does. On decentralized platforms, it's probably much harder because you can reconstitute every transaction from smart contracts. And so there is an algorithmic aspect which certainly makes for a level of transparency that you don't have in centralized finance, which, by the way, is very interesting because it's decentralized and something that is very new, and it has built-in transparency in it. There are other problems, but it has built-in transparency in it, which is very interesting. So yes, it's a much more difficult job than in traditional finance, but it doesn't mean that it's impossible. Okay, if you're a trading venue, first of all, we're trying our best to do that. What we're collecting the data, we have a PhD candidate working on making sense of that data, trying to identify manipulation or at least manipulation patterns, because it's very difficult to say this particular order is meant to manipulate the market. What you can say is this particular order is very strange, and chances are it's not a genuine order, and it's here to bias the order book. So there are limits to what you can do, but let me offer a few ideas. Number one, we can do a few things. So we are building expertise on that. Number two, the industry itself should think about those issues. Okay, how do I, as an exchange, how do I promote the idea that I'm not open to fake volume? Okay, if you're an exchange, it's your responsibility. Nobody can assume that responsibility for you. So what our exchange is doing, what our decentralized platform doing, what is the industry doing to eliminate fake volume? Okay, and by the way, it's a tricky question, because if you eliminate fake volume and suddenly you realize, I don't know, that 50% of the volume is fake, then volumes will decrease by 50%, which is not good. Okay, and I can understand that. So coming from a world where there was no regulation and you can put out the data you want, migrating to a world where you are going to be held to a different standard, and if you really want to go in the right direction, you're going to have to yourself police your clients, your order book, so that you get rid of fake volume. This is not an easy transition. Okay, but as I said earlier, we strongly believe it's a transition for the best. Number one, because traditional institutional investors will not accept to trade and transact in a market so opaque and so manipulated. They just won't. The regulator won't either. No way, because it's been working very, very hard over the past 25, 30 years to make sure manipulation doesn't happen in traditional market. And I mean, I could give you tons of examples where there were legal actions and class actions and so on about those issues of manipulation. So the regulator has been working very hard to eliminate manipulation. So it's not going to stop them. And by the way, it has the tools. We know what the regulator did because it did it in traditional finance. So we know what's going to happen in crypto if nothing changes. So institutions won't come. Regulator won't open the door for the small guy. And so if crypto wants to be much more than a marginal tech on the side of TradFi, it needs to take a few steps forward in that direction. And yes, it's going to be hard, and it's a transition, that in transition towards maturity, that we think is necessary. I mean, it's unavoidable, really, in fact. Okay, so we'll see how long it takes to happen. And if it doesn't happen, then, well, it will remain a marginal asset class.
Very insightful. So I guess that you, Sanzu, as the pioneer, is really doing its part, with the adoption of those institutions. Pratik, do you have any other questions?
No, not really. That was very insightful as well. Yeah.
Thank you very much, guys. And well, we look forward to watching the podcast.
Thanks, Stefan.
Thank you for joining us, Stefan. And moving on to the next section, essentially 2 Twitter threads that you need to be aware of. The first one is how a Twitter user helped prevent a 200 billion BitBTC exploit. So the Twitter user named Plasma Power 0 publicly flagged a vulnerability in BitBTC optimism breach, helping avert the exploit. Following BitBTC's rejection of his messages, it is clear that Ethereum scaling solution Arbitrum published the critical exploit in a tweet, essentially. So what was the issue all about? BitBTC breach to and from Optimism blockchain enables withdrawals of any token between the L2 and the corresponding layer 1 address. So however, the breach code does not verify which token on L2 is being breached and mints an arbitrary L1 token to match it, which means an attacker could deploy their own token on Optimism, the L2, gives themselves all the supply control, and set the corresponding L1 token address to the real BitBTC L1 address. So when the attacker withdraws their malicious token through the BitBTC breach, it gives them the real BitBTC token on L1. What is interesting is the following day, an attacker claiming to be testing the code tried to withdraw 200 billion BitBTC from Optimism. However, the attack was stopped, as the bridge is based on optimistic rollup mechanism, meaning that the process of withdrawing the token from the bridge would have essentially taken 7 days to complete, and BitBTC team meanwhile patched the vulnerability through a software update. So what's the take on that, Pratik?
The take on this is, like, we've seen time and over again that bridges are the easiest target for attackers. right? And bridging teams need to take security seriously. In this case, the team was lucky as the optimistic bridges by design have this 7-day challenge period, which allows the nodes on the bridge to stop any malicious transactions within those 7 days. However, there are other bridges where the challenge windows are quite short, as small as 30 minutes in some cases. And so in these cases, quick and prompt action is of essence. And as a user, it is very important to understand the risks involved in each type of bridge designs, be it centralized bridge or a multi-sig bridge or a decentralized bridge. And we talk about these different bridge designs and the security assumptions involved in each of them in our next long-form research report, which is titled Interoperability of Blockchains, and we will be publishing it in December. So keep an eye out for this report. So next, that's the end of Twitter thread 1. Moving on to Twitter thread number 2, we are talking about JP Morgan executing its first trade on chain. So let's see what happened here. On November 2nd, JP Morgan, along with DBS Bank, which is a Singapore bank, and SBI Digital Assets Holding, which is in Japan, executed a currency trade involving tokenized Japanese yen and Singapore dollar deposits. So the trade was carried out on Polygon blockchain using a modified fork of Aave Arc. And Aave Arc is a permission institutional version of the Aave protocol that we're all familiar with. So why did they use this modified fork of Aave Arc? So that they could set the interest rates and FX rates manually. So why is this important? The thread lays out 3 major points why this is important. So first, banks are joining DeFi. Rather than building solutions on a private permission blockchain hosted by JP Morgan servers, which in fact exists, right? They have Onyx blockchain. They're actually now choosing to explicitly build products on permissionless open source blockchains like Polygon. So this is huge. Second point is they're choosing Ethereum preference. So Ty Lobin of JP Morgan, who works on the permission blockchain Onyx, which is by JP Morgan, explicitly expressed his desire to use Ethereum in his tweet. He said that Polygon was used for the trade because they wanted to do this on Ethereum, but they needed cheap gas fees. And at the moment, gas fees on Ethereum are expensive for them to try this out. So that's why they went on Polygon. But they are very clear that they want to use EVM or Ethereum for their transactions. And next, they said they used Aave, which is the Aave Arc, so that they could leverage a permission pool concept. They deployed a modified version of the Aave Arc, as we said earlier, to set manual parameters such as the interest rates and the FX conversion rates. And the third important thing in this whole transaction is that they used verifiable credentials on chain. So one mechanism that was used in this transaction was verifiable credentials, which is VCs, which allowed users to present the necessary compliance information to third-party verifiers, which can then let issuers know of compliance without revealing any sensitive data. They used what's called W3C, which is World Wide Web Consortium, verifiable credentials to provide compliant access to Aave or any other DeFi protocol. Verifiable credentials give much more fine-grained control than just whitelisting addresses, right? You can limit the risks, you can limit the assets. All of this is possible with verified credentials. What's even more interesting is that they built on-chain verification, know how to verify certain things, and use them across different decentralized applications, bringing further standardization and portability to the identity. Ty Lobin said that this design is in a way that ensures verifiable credentials-based compliance checks can be used with any DeFi protocols, without those protocols really needing to know anything about those credentials themselves, right? And this will free the DeFi protocols front ends from needing KYC checks. This is huge. The other important thing he mentioned is, although they did not use zero knowledge proofs in this current model, they do plan to use it in the future iterations of the verifying credentials. They have co-authored a long-form report titled Institutional DeFi, and they dive into the further details of this whole transaction and this collaboration and what it means for the future of institutional finance in the decentralized space. And this whole project is in collaboration with the Monetary Authority of Singapore. So very regulated and institutionalized trade. So what do you think about this transaction, Jerome?
Like you said, definitely good to see those collaboration between, institution and regulators. I would say this is really huge step forward for institutional DeFi becoming a reality. We've saw that there's multiple reasons why big institutions are holding back from participating in DeFi. We highlight several of them in our recent 321 Q&A sessions that you guys can watch on our YouTube channel. So you can just type in the URL youtube.com/@coinchange. What is very interesting though is that it shows that institutional adoption can essentially come from two sides, right? So one being through DeFi protocols, attracting institutional capital through new product. So they will essentially spin off product dedicated to institutional clients with different with their requirements. And then on the other side, we have institutions themselves, like in this case, adapting decentralized finance application and protocols to fit specific needs, with the objective to create less burdensome and more efficient version of traditional financial instruments, be it, for example, impact finance, bond issuance with Société Générale back a few years ago, or operational financing, etc. And this concludes Twitter thread number 2. We will move on to the last section, the DeFi hack, where we have Derebit, which essentially launched back in 2016. And Derebit is essentially a leading cryptocurrency future and option exchange that enables crypto traders to execute derivatives trading strategies. So predict what went wrong with Derebit.
So their hot wallet was hacked. It was a hack for $28 million on 1st November. And in a tweet, they said that their clients' funds are safe and the loss is covered by company reserves, which was a bit confusing at first, because how can your client funds be safe if you just lost $28 million? But they do clarify this by saying that it's their company's procedure to keep 99% of their users' funds in cold storage to limit the impact of these types of events. And so only 1% was in the hot wallets. And they have enough company reserves, which they've saved through profits, the income for the company, which is going to be used to cover for the losses. And that's why they mean that no users' funds have been lost, because effectively they have backup reserves to cover for these losses. So also, the hack was only limited to Bitcoin, Ethereum, and USDC hot wallets, where all of the tokens in these wallets got drained completely within minutes. And they halted withdrawals just to make sure that it is safe to open it back up till they figured out what exactly happened. So let's look at how this happened. The attacker was able to get access to their hot wallet server, which enabled him or her to withdraw the funds from these hot wallets. They withdrew BTC, ETH, and USDC, and then later converted all the USDC to ETH. So currently, the stolen Bitcoin and Ethereum sit in an externally owned attacker's wallet, which is outside of Derebit exchange, and so they cannot control it anymore. Now, how did the attacker get access to the servers in the first place is still not clear. Was it a regular phishing attack, like in case of the Ronin Bridge hack that gave the attacker access to the servers? Or was it an insider who already had access to the server? We don't know as of this recording. So how will they make up for the lost money? Well, they have two ways to make up for lost money. They have insurance funds and they have protocol reserves. And in this case, they mentioned that they're not going to touch the insurance fund and it will not be affected. So what they're going to use is the protocol reserves, which is the income for the protocol, and is sufficient to cover the losses. They do not openly communicate about how much they have in the reserves, but in the insurance fund, they do have about 40 million US dollars. Now, how did they fix this issue? Well, they regenerated the deposit wallet addresses on the front end, and they removed the old deposit addresses. Second, they migrated all their hot wallets to Fireblocks, which is what resulted in changing all the deposit addresses for Derebit. The on-chain withdrawals now require a manual approval for the time being by a Derebit admin on the third-party Fireblocks application. So this is temporary, but still it requires a human intervention. And lastly, they have appointed an on-chain forensics company to assist with tracking and recovery of the assets and liaising with the global law enforcement. They said that they're open to making this a white hat attack if the attacker is willing to return some funds and keep some as a bounty. So it's still new, so we need to keep an eye on the progress and the updates as this goes. So Jerome, what do you think about this? What's our take on this?
I mean, like you mentioned, still it's rather unclear what's really the attack vector on the Web2 side. But one thing that is clear is that it's definitely not a Web3 attack vector, and that's one of the issues that we have essentially in Web3 is that we really have a tendency to emphasize too much on smart contract audits, coding best practices, which is essential, but not sufficient. We simply cannot ignore traditional cybersecurity best practices of Web2, such as keeping your server secure so that hot wallet keys are not lost or essentially hacked in this case. And it feels very surprising as well that an exchange that has been operating since 2016, essentially 7 years ago, gets attacked for a traditional cybersecurity issue. We talk about this in much detail in our next long-form research reports on the interoperability of blockchains, which will be released in December. But the bottom line is we should make sure that the Web2 infrastructure that essentially enables Web3 application to work is that we need to make it secure, and those best practices needs to be really ironed out by everyone in the space building. And this concludes our 3-2-1 Q&A podcast today. We'll see you in the next one 2 weeks from now. Meanwhile, kick back and earn passive income using CoinChange. Take care, everyone.
Take care, everyone.